Welcome back to Trendlines Over Headlines, the show where we break down the markets with some of the best traders and analysts out there. My name's Patrick Dunawilla. I'm the editor of the Chart Report, and I'll be your host. Joining me to make sense of the markets today is Willie Delwiche. Willie is an investment strategist and founder of Highmount Research. His work is focused on the bigger picture trends, and he's constantly weighing the bullish and bearish evidence in order to stay objective and unbiased. But before we talk to Willie, the week is over, so let's take a quick look at how it shook out. Hey guys, thanks for watching. Just a quick reminder, be sure to click like and subscribe so we can continue bringing you awesome content. Thanks. So it was a shortened week with the markets closed tomorrow for Good Friday, but the Dow was the only major index that closed positive on the week, gaining a little more than 0.5%. The S&P 500 was essentially flat on the week, leaving us with this doji candle on the weekly chart. If you don't know what a doji is, it's a candlestick that opens and closes at virtually the same price, but it symbolizes indecision between buyers and sellers. So not a whole lot of information from the S&P 500 this week. We're still just range bound, and that 4,100, 4,200 level continues to act as resistance. On a weaker note, small caps lagged by a notable margin, with the Russell 2000 dropping more than 2.5%. There's a lot of eyes on this Russell 2000 chart here as it tests this crucial level around 1,700. Those were the 2018 highs and the pre-COVID highs. And here we are testing it again for the third time in the past year. So the bulls really need small caps to step it up here. Now, taking a quick look at the sector performance, utilities and healthcare led the way, gaining a little more than 3%. On the other hand, industrials and consumer discretionary lagged, dropping more than 3%. In any case, that's enough from me. Let's welcome Willie onto the show. Willie, it's great to see you, and welcome back to the show.
Thanks, Patrick. Thanks for having me.
Yeah, and congratulations on the new launch of your newest venture, Highmount Research. Could you tell us a little bit more about it?
Sure. It's an idea that's been percolating for a couple of years for me. It's an attempt to kind of step back from some of the day-to-day ins and outs of the market and focus on the things that really matter. Kind of think about turning information into insights, and then those insights into portfolio applications, trying to be independently minded, evidence-based, and visually engaging. So, it's exciting to reach out to advisors and really help them think about not just the past 10 years, but the next 10 years in the market.
Well, listen, we wish you the best of luck with it. And I've always appreciated your kind of long-term perspective. And I like how you kind of weigh the bullish and bearish evidence. It's an excellent way to kind of approach the markets with an objective lens. And one way you do that is through this bull market checklist of yours, or bull market behavior checklist. So let's take a look at that. Break it down for us. And is the checklist leaning bullish or bearish at the moment?
Yeah. So last year we were thinking more about bull market rebirth. We focused a lot on that, and we started to see kind of the conditions being in place for a new bull market. Really got to 5 out of 5 on that checklist. And so then we thought it would make more sense, rather than thinking about those conditions, see if the behavior was matching what we would expect in a bull market. And here, if you look at it broadly, and we'll get into the details, but it's what's happening beneath the surface, and then some of the longer term trends. So, from a weekly perspective, are we seeing more stocks making new highs or new lows? Are we seeing, and in the case here, we started off this year seeing that. It was a great change of character from last year. Now, over the past few weeks, we've kind of reverted back to the pattern of 2022, where it's back to more new lows than new highs. Next up would be that net new high advanced decline line. And we're talking, you said, is that just like an advanced decline line? It is, but it's not stocks going up versus stocks going down. It's stocks making new highs versus stocks making new lows. And the reason I like to pay attention to that, not not the absolute number of stocks making new highs or the absolute number of stocks making new lows, but the difference is because it matches over time the pattern of the S&P 500. And if you've got more stocks making new lows and new highs, and you're thinking that the indexes are going to rally, you're fighting the tape. And that's the case right now. We've got more new lows than new highs. You can think about it from a global perspective. That's our percentage of global markets above their 50-day average. The kind of three broad ranges here. Anything above 70% is generally good. Anything below 40% is generally bad. Between 40 and 70 is a bit more of a mixed bag. What we've seen recently is a lot of strength. We had 90% of stocks of markets above their 50-day average collapse last month down to 4%. It's recovered, but it's not gotten back in gear just yet. And then we can think about it as well from just a trend perspective. That the ACWI trend, we showed the S&P 500 long-term trend. ACWI and S&P 500 over time, they've been consistent enough that we don't need to show the ACWI right now. The S&P 500, we use a 200-day average there. Interestingly, that's the one area that when we update this at the end of this week, we're actually going to see some improvement, barring something dramatic as the week comes to an end. That 200-day average will actually start to move higher. And then finally, it's a value line geometric index. I think you've got a chart of it. Yeah, that's a bunch of sideways over the past, almost a decade now. You keep going back and forth between 500 and 600, keep retouching 550. I mean, if there's anything that epitomizes a lack of uptrend, I think is this value line geometric index. Not necessarily a downtrend, but no uptrend.
And Willie, could you just elaborate and tell our viewers a little bit more about the value line geometric index? Why do we look at it?
Yeah, we look at the value line geometric index because we like to be really obscure and focus on things that people haven't heard of. No, it's the median. It looks at the median stock in the value line universe. It's 1,600 stocks. So you get rid of the outsized influence that you get from the mega caps in something like the S&P 500 or the NASDAQ 100. This looks at the median stock, and over the past few years, the median stock's not really gone anywhere.
Yeah, it kind of gives you a much broader view of the stock market than something like the S&P 500, which we always look at. But you touched on it a little bit, but I know you do a lot of work on breadth. So I want to get your perspective on that because it's a pretty hot topic right now. Everybody is concerned over this mega cap leadership. It seems like mega caps are the only ones kind of propping the market up right now. And I want to ask you what you think of that. Is mega cap leadership a concern of yours right now, or do you think fears are just kind of overblown? Do you think the big boys should be doing what they're doing?
Well, I think there's a couple ways that you can frame the answer. One, the mega caps, by and large they're tech right now, so it seems like it's speculative tech. I think in this environment they become the safe haven. And so seeing, in the wake of, in the wake of the bank crisis, seeing money flow towards those mega caps isn't too surprising. I think from a broader perspective, it's not so much whether the mega caps are leading versus lagging, but whether they're moving in the same direction as the rest of the market. If the mega caps are leading, so if the generals are leading the charge, but the army is coming along behind them, there's no problem with that leadership. The issue comes if you've got the mega caps leading the charge and the army, the small caps, the average stock, the value line geometric indexes are heading in the opposite direction. It's not horrible at this point, but at the margin, it's getting worse. Maybe that's the way to frame it. It's not broad weakness that you're seeing at the average stock but you're seeing deterioration. That's what you're seeing in terms of the expansion of new lows, the absence of new highs. So the mega caps are big enough they can hold up the indexes for a while, but that also comes with a lot of risk. And over time, the indexes don't usually go up if beneath the surface you don't also have strength. I
see. So you kind of need some of those smaller guys to pick up the slack pretty soon. But in addition to breadth, I know you do a lot of work on sentiment as well. So I have this chart here. It's Justin Mames's, classic sentiment cycle framework. So, if I had to ask Willie where we are on this sentiment chart, where do you think we are? And what's your read on sentiment right now?
Yeah. So I think from a sentiment perspective, and we'll get into this in a minute, it's different from positioning, but from a sentiment perspective, last year we probably, in the terminology of this chart, saw discouragement. We saw peak pessimism. Then we started to see optimism come in. And this, I think, is where people get the conversation about sentiment mixed up. After you've seen that discouragement, after you've seen peak pessimism, optimism is a friend to the bull. You want to see optimism come in. You want to see, bull markets take the field. That's what creates higher prices is bulls.
Yeah, I think you said once you need bulls to have a bull market, right?
Yeah. Go to the next chart. It's a great example of this. This is the Investors Intelligence data. We looked at it going back to 2015, and all the net gains in the S&P 500 have come after the bull bear spread has crossed above 18%. So, and we've struggled with that level this year. That was the peak back in August. We got briefly above it in January, then started to struggle. And I've talked about in recent weeks that the worst thing that could happen right now is to see pessimism reemerge, because then you've got overexposed investors becoming less interested in stocks. And that's where you get some of those longer term positioning questions start to be answered. What would it take for investors to kind of shift away from equity exposure? It's volatility, it's pessimism over time. That's the longer term risk. Short term, we want to have optimism. Longer term, we've got a bit too much optimism.
I see. So it's you're kind of saying that there's this divide between short-term sentiment and long-term sentiment right now. Is that correct?
Yeah, very much so. And that emerged last year. Typically, you see sentiment and positioning kind of moving in the same direction. When you have lots of optimism, you tend to have elevated levels of equity exposure. When you have not very much pessimism or lots of pessimism, you have low levels of equity exposure. This asset allocation survey from the AAI shows we had elevated equity exposure all of last year, stayed above average for the entire year. Exposure to bonds and cash remains below average. And so talking about short-term pessimism, yeah. Have investors done anything about it? Not so much. And really that's what drives long-term returns, is when investors have done something about how they feel about the market. And that's what, I think that's the message from this chart, that compares household asset allocation. Here we're looking at the ratio between stock exposure and bond exposure and comparing that to forward returns for the stock market. And it's an inverted relationship. So when the stock bond ratio is high, forward returns are low. When that ratio is low, when you have lots of bonds, forward returns for stocks tend to be high. Right now,
and that orange line is pulled up 10 years, right? It's the returns 10 years forward.
It actually stops 10 years ago, because we don't know yet what the returns for the past decade are going to be.
Wouldn't it be nice if we did?
Yeah, exactly. But the blue line there suggests that they're not going to be as strong as what they were over the past decade. That's the real takeaway here. A decade ago, investors had low levels of equity, high levels of bond exposure. The exact opposite right now. You got 3 times as much equity exposure as bond exposure. And when that's happened in the past, equity exposure or equity returns have suffered.
I think that's a good point. And this is kind of just another way to look at that, right?
Yeah, that's exactly right. So here we're looking at household equity exposure as a percentage of liquid assets. So it's bonds and cash in there. Take out household, house equity that you might have. So it's stock exposure relative to liquid assets on the bottom there. And then on the top, that's the S&P 500. And this goes back to the 1950s. And the point here, and this is a kind of preparation for investors who are used to the S&P going up and to the right, is that in the past, when we've gotten elevated levels of equity exposure, the stocks have stopped going up and to the right for a period of time, and they've gone sideways. This isn't a call for a market crash or saying that there's something cataclysmic. It's just, if your expectations are stocks always go up and to the right, be aware that there have been lengthy periods in the past when they've gone sideways for a decade or more. And from a positioning perspective, it looks like we're at the beginning of another one of those periods.
I see. So to sum it all up, it kind of seems like, investors might have said they were very bullish in some of those surveys last year, but in terms of what they did about it and how they're positioned, you aren't really seeing that fear yet.
Right. We haven't seen that fear. And then the takeaway from it is that we're sitting on top of, even after last year, we're sitting on top of a lot of gains over the past decade and investors that are heavily exposed to equities. And it would be outside the normal for a repeat of the past decade, meaning sustained above average strength, to persist. And it's time for investors, I think, to start to remember the lessons of the past and think about, equity exposure beyond just what's in the US, or asset allocation positioning beyond just equities, and kind of reintroduce questions that have been forgotten about.
Yeah. Well, Willie, I want to move on to yields real quick because Treasury yields seem to be driving so many of the trends across the market still. The 10-year is trading at a 6-month low right now. It sliced through support this week around 3.4. But then you have another shelf of support right under it that we're kind of testing now. It's kind of a big area between like 3% and 3.2%. But, that was resistance in 2013, 2014, and then again in 2018. Should we expect it to offer some support here? What's your outlook on the 10-year? Do you think we maybe just chop around in this zone between those two?
Yeah, I mean, if you look from a long-term perspective, we're off our highs. We haven't really broken down, and you zoom out even further, and it looks more like the early stages of an extended move higher than some sort of exhaustion. I think really we need to understand what's happening from a yield perspective, not just on its own, but also relative to what the Fed is signaling. And the Fed's signaling we need higher yields still. We need higher rates. The bond market believed that prior to Silicon Valley Bank blowing up. But since then have come around to this view that the Fed's going to not just pause, they're actually going to cut rates going into the end of this year. We can ask all sorts of fun questions about should they or shouldn't they? What could that mean for equities? What might that mean for equities? I think the best way to think about this is to look at yields and yield momentum from a corporate perspective. So corporate bond yields. And there we don't need to come up with stories. We can just look at the data. And we can see that upside momentum in corporate bond yields, BAA corporate bond yields, peaked last year as yields got to their highest level since 2010. Since then, yields have moved sideways, but momentum has turned negative. And the important part of this, Patrick, is that not every time, but in aggregate, when we have seen bond yields fall since 2000, since 1965, that's when all the gains for the S&P 500 have been realized. So we can talk about should they or shouldn't they from a Fed's perspective. Is the bond market right or is it wrong? But that is almost secondary to the fact that when corporate bond yields are falling, stocks tend to rise. When corporate bond yields are rising, stocks tend to fall. Right now, wherein corporate bond yields are falling, that's improved liquidity for the stock market. That's actually a very bullish development that we've seen over the past couple weeks.
Interesting. And to go back to the weight of the evidence, sounds like this one is one that kind of goes against the bull market checklist checklist, which is bearish right now, this one's actually pretty bullish. Is that right?
Yeah, very much so. And so we have we have some scales that we kind of go beyond the technicals, look at the macro influences and the market influences. And as I was updating them this month, we took breadth off of the bullish side. We took sentiment off of the bullish side. We talked about the reasons for that, but we also took financial liquidity off the bearish side for exactly the reasons we're talking about here in terms of corporate bond yield. So, again, we can get stuck in our narratives and think that things might happen or think that things should happen. But at the end of the day, we need to listen to the market and pay attention to what is happening. And what's happening is bond yields are falling. That's a tailwind for stocks.
Right. But so overall, it seems like your checklist, your models are pretty bearish right now, or at least cautious. So what do you think investors should do? Do they just hide out in cash this whole time until the data improves? Or are there other areas of strength that you think will outperform stocks and bonds?
Yeah, so I think to label the data as bearish or cautious, it's bearish or cautious relative to the way most U.S. investors have exposure, which is U.S. large cap growth, and it's bearish with respect to expectations developed over the past decade. If we take a more global perspective from equities, for example, we can see that the rest of the world is gaining strength versus the US. Not many US investors are prepared for this, in part because it's been a decade since it's happened. And you can see, we got the ratio between the US and the ACWI or ACWI-X, and our long-term trend. And at the bottom there, you can see, number of weeks in a row that the US has been in the lead versus a number of weeks in a row that the rest of the world has been in the lead. It's been over a decade since we've had an extended period of global leadership outside of the US. And so I think this is a paradigm shift for many investors. It's not new. It's actually old, but it's unfamiliar for investors who don't have the perspective to say, okay, what happened in the first decade of this millennia? What happened prior to that? If they're just stuck in the past decade, then yeah, the world seems unprecedented. So to answer your question, think about the rest of the world. Think about Europe. Think about UK. From outside, other areas. Think about bonds. Bonds
well, to stay on that topic for a second, it really seems like, and I understand what you're saying, the kind of investor psychology that's been put in place over the past decade because this trend has been so pronounced. It's going to take a while for them to move towards that trend. And it's going to take that outperformance probably, because it seems like, the boy who cried wolf with things like this, because it seems like every year we hear, oh yeah, this is the year that emerging markets or the rest of the world outperforms the US. But for the past 10 years, that has not come to fruition, right?
Yeah,
You're saying I think and it is kind of starting so far in 2023, right?
It started last year, and it's continuing this year. But yeah, it will take time for investors to embrace this. I think it will also, for U.S. investors, it will take work to embrace this. I was going through some of the model portfolios that we manage, and trying to position for this in terms of more global equity exposure than U.S. equity exposure in those portfolios, and it takes active work to do that. From an ETF perspective, there's way more ways to slice and dice the U.S. market than there are to slice and dice the global market, and so it might mean putting larger chunks in single ETFs than you would if you were in the U.S. But I mean, that's where the opportunity is right now. It's underexposed. U.S. investors are underexposed to the rest of the world. I think it's a mind change that needs to take place. We could talk about it as well with respect to commodities. Commodities had a great run, off of its COVID lows into early part of last year. The problem for many investors is that it comes after a decade of weakness, many investors didn't have any exposure to commodities, and so they weren't in a position to take advantage of that. And I was going through some old model, some asset allocation framework stuff from over the past decade, and a decade ago, commodities were included, as asset classes in firm level asset allocation matrices. By 2020, they disappeared because
and why is that?
Because after a decade of underperformance, they got forgotten about.
Very similar to the outside the world or emerging markets type theme.
Exactly. And so we can think about commodities. You're showing a chart of the CRB kind of going sideways. And
you know what? I'm glad you brought it up too, because we did see kind of a fake out this week, right? Or maybe not this week, over the past month or two. It broke down, and then here we are with crude oil ripping on Monday. We're back above that former support level, right?
Yeah, and so the lesson here is, when commodities got weak, then maybe they were weak enough to fall out of a portfolio. The important aspect is, take them out of the portfolio, don't take them off the table. Keep them as part of the conversation, so that when you start to see strength again, then you are in a position to remember commodities. You can't add what you don't talk about. You can choose not to add what you do talk about, but the moment that's out of the conversation, it's no longer part of the opportunity set. And if there's anything from this coming decade that I want to stress is keep your opportunity set as broad as possible. Then you can make your decisions. But if you narrow your opportunity set, you have excluded the ability to include that. And what you're showing now shows the benefits of periodically rotating into stocks and then periodically rotating into commodities. You come out with better returns and less volatility if you follow the strength of the trend between the S&P and the CRB. When stocks are leading, rotate into the stocks. When commodities are leading, rotate into commodities. Doesn't mean you always have commodity exposure, but when commodities are strong, you want to have that exposure.
I see. That makes sense. And it kind of pairs with this one too, right? Where, like what you were saying, when commodities are leading, have exposure to commodities. When stocks are leading, have exposure to stocks, right?
Yeah, exactly. And with respect to this chart, just it hammers home, a decade of no commodity strength. I think, prior to that 107 weeks in a row of CRB leading the S&P 500, I think the 8 or 10 years prior to that, it was like 95% of the weeks, the S&P was in an uptrend relative to commodities. So there wasn't a reason to have commodity exposure. But you go back prior to that and you had sustained periods of commodity strength. And, those kind of orange daggers that show up, that's commodity leadership. But it got forgotten about. That's the lesson is you forget about past strength and you take something off the table. You don't have the opportunity to participate in strength when it does reemerge. And most of these things happen in cycles. Maybe they're short cycles, maybe they're long cycles. They tends to go through cycles over time, and you want to be positioned when you see new strength, new leadership emerge. And usually it's not new, it's just something that you'd forgotten about.
Yeah, and I like what you said there earlier about how and I think it's a good way to end with a nice message, which is just kind of keep an open mind in terms of your opportunities out there, whether that's, global equities or commodities. Don't necessarily lean on these old relationships that have been in place for the past decade. Is that fair to say?
Very, very much so. Remember that the last decade was in some ways a historical aberration. And if the environment that led to that strength isn't there anymore, you can't expect those relationships to hold. And to go back to what you said about people crying wolf about leadership emerging, you can have a view, but then let the market test it. And if the market is testing and showing strength in, for example, commodities versus stocks, or showing strength in the rest of the world versus the US, then you lean into it. You don't say, well, it's going to happen, and just close your eyes and trust that it will because you thought it might.
I love it. Listen to the market and let the market tell us what to do, right? But anyway, exactly. Willie, we've got to leave it here, but thank you for coming on the show and sharing your perspective, and enjoy your long weekend. I hope you have a happy Easter.
Yeah, thanks a lot, Patrick. You too.
Cheers. Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe. Enjoy your long weekend, and we'll see you again next week. Thanks.